Now, moving on, let's talk about the different types of Forex orders, right? So in this section, it's all about, learning the different types of Forex orders. And one thing to point out is that there are many more different types of orders that you can use, especially when you're using professional trading platforms. But the ones that I'm about to share with you right now is, I would say, the ones that you are likely to use, right, most of the time. Okay, so let's get started. First one, market order. Second one is a limit order. Third one is a stop order. And finally, a stop loss order. So let me explain each one of them step by step. First one is a market order. So let's say it's a buy market order because it could also be a sell market order. The concept is the same, but in this case, let's go with, let's say, a buy market order. This is, in essence, right, you're trying to, buy at the current market price right now, no matter what. So this is like, sending an order to your brokerage platform and say, hey, I want to enter Euro USD right now, no matter what. Now, so your broker will fill you at a trade at the current prevailing price. So the pros to it is that, you're guaranteed to enter a trade. There's no what if, but, or whatsoever. You're guaranteed to enter a trade. But the downside to this is you might get slippage, right, during fast moving markets. And you might be thinking, Rainer, what is slippage, man? So here's the thing, right? In the Forex market, yes, it's liquid most of the time. But when there's a big piece of news coming out, like let's say, NFP, non-farm payrolls, or FOMC meetings, right? Let's say Euro USD is currently trading at 13000, right? But during fast-moving markets, if you hit market order, right, you could get slippage, right, where you thought, hey, I'm going to buy at 1.3, but you end up, buying actually at 130, let's say 20. You end up paying 20 pips more than expected. So this is kind of like the downside to using market order because of this slippage. So instead of buying at 1.3000, you end up buying at 1.3020. A slippage of 20 pips. So in other words, you're paying 20 pips more than you expected. Okay, so this is a market order. The other type of market order, right, is limit order. So again, let's talk about buy limit order. Sell limit order is just the opposite. So for a buy limit order, right, it's an order to buy below the current market price. So let me give you an example. So let's say market is in a range between these highs and these lows. It goes up, comes down, goes up, and now it's in the middle. And you think to yourself, man, price right now is in the middle, right? I want to be a cheapskate. I want to buy the best price. And then it seems like the best price is near this lows over here. And let's say this is Euro USD, this lows is around 1.5. Okay, so what you can do is you can place a buy limit order at 1.5000, so such that if the market comes down into this level, you will get filled on the buy trade. But of course, if the market doesn't come down, you won't get filled. So that is kind of like the pros and cons to using a buy limit order. So let me give you a chart example. You can see what I mean. So this is, for example, pound Canadian. Let's say you're looking at this chart maybe on the 8-hour time frame. Okay, and you zoom out a little bit and you realize, oh, this market, right, this seems like a good place to buy. This is an area of support. Don't worry if you're not familiar with this technical term, I'll explain more in the later section. But let's say, hey, you want to buy around 172, right? This looks like a good place to buy because the market has bounced once, twice, at 3 times over here. This looks like a good place to buy. But the current market price is at this point over here, which is almost near 1735. So what can you do? You can place a buy limit order over here, a buy limit at 1.72. So this means only if the market comes down low enough into this 1.72 level, only then will you get filled. If not, you won't be in this trade. So this is what a buy limit order means. So of course, right, the good thing about it is that you get to buy at the price you want. The downside is you might not get filled on the trade. So maybe you're waiting for that level, but the market doesn't come to that level, and instead it continues going up higher, then clearly, right, you wouldn't be in the trade. So vice versa, right, for a sell limit order, the concept is just the opposite. So moving on, the third type of order is a stop order. So again, let's talk about buy stop order. So this, in essence, right, is an order to buy only if the market moves above a specific price level. So you might be thinking, what does that mean? So again, I can give you an example. Let's say market is, let's say it's trending higher. It goes up, pulls back, goes up, pulls back, and it's starting to go up. And you tell yourself, I'm looking at this chart and it would make sense, right, that I want to buy only if the price can break above these highs. Because if it can break above these highs, then there's a good chance that this market could continue higher. So you want to tell yourself, I will only buy if the price can break above this high. If it doesn't break above this high, I will not, enter a trade. So what you can do is to use a buy stop order. So an example is this one here. if you look at this chart, dollar against the Chinese yuan, this is the 8-hour time frame. So again, you can look at this and say, at this point, right, Rainer, I have no idea when the price might go up and come back down, and again, I don't want to enter right now because, this could happen. And then you're thinking to yourself, I feel more confident if the price can break above these highs. Only then I would be willing to buy. So if that's your thought process, what you can do is you can use a buy stop order. You can place a buy stop order at this price, around $6.59 around this price point, which is somewhere about here. So you can place a buy stop order here. Let's call it BS. Buy stop, not BS that you're familiar with, but buy stop order at $6.59. So such that if the price goes up and breaks above $6.59, this is an order that would automatically get you into this trade, right? Because it broke above this key level 659 that you have put into your broker platform. So it's an order to buy if the price moves above a specific price level. So this is useful, right? If you are trading breakouts, this order is absolutely useful, because in breakout trading, the price would break up of a specific level and then you'll continue with the momentum, right, to hit higher. So if you have a buy stop order, you are kind of like assured to enter, right, if the price could break out of a level. The downside to this is that it might be a false breakout. So again, what could happen is that, let's say pound, the dollar against the Chinese yuan. So this is the highs, price will go up, break out, and then boom, reverse. Right? This is possible as well. Anything can happen in the market. So this is one possibility that could happen, right, if you are using buy stop order to enter a trade. So the next type of order, right, will be stop loss order. So the first three orders that I shared with you, right, those are orders, right, to get you into a trade. So for stop loss order is the opposite, because this is an order to get you out of a trade. So let's say we are going with a long entry, okay? So a stop loss order is an order to sell your position if the price exceeds a specific level. So for example, let's say market is in a range up, down, and it start to go up, okay? And this is the area of support. And you start to buy over here, okay? And what happens is that, as you know, in trading, nothing is certain. There's a possibility that this market could continue to reverse down lower and lower. And if you don't bail out of your trade in time, right, you could lose a lot of money. So this is where you can use a stop loss order and say, hey, you can tell your broker, hey, you know what? If the market, breaks below this level in red, okay, if the market reaches this level in red, I want to get out of that trade. So to tell that, you will tell your broker to set a stop loss order at this particular price. Let's say this price is at $2, right? And you will exit your trade. So this is what we mean by a stop loss order. It's an order to sell your position if the market moves against you and reaches a specific price level. So a chart example would help. So let's say you look at dollar against USD against the Singapore dollars. So you can look at this, right? Market right now looks a little bit bullish, right? This area of support, and it's starting to hit higher. But of course, as you know, market could possibly reverse down and break lower. So to protect your downside, what you can do is to set a stop loss order. Okay, so this is the area of support, and what I would say a proper stop loss order could possibly be at 133.6 level, around here. So this means, right, you can tell a broker and say, hey, I am long USD against the Singapore dollars, but I know the trade could go against me, so I'm going to set a stop loss order at 1.336. So if the market, let's say, reverse down lower and hit my stop loss level, which is this one over here, the stop loss level, I will want to sell the position that I have to protect my downside so I can leave to fight another day. So this is how a stop loss order works. It's to protect your downside. Okay? And of course, right, the downside to using a stop loss order is that you might get stopped out of your trade prematurely. So what could happen also is that, okay, let's say you set your stop loss at this level here. There is nothing to stop the market from coming down lower. When you hit your stop loss and then reverse up higher, that could also happen. So this is kind of like the downside to using a stop loss order. But as a Forex trader, as a trader who uses leverage in your trading, I still suggest to use a stop loss order. Sometimes, yes, this could happen. It sucks, but in the grand scheme of things, right, you will likely, right, have a longevity in your trading career because your losses, right, are always kept small. And that's achieved by using proper risk management and position sizing. And again, those are things that you have learned earlier, and we'll revisit them later with chart examples. But for now, I just want you to be familiar with a stop loss order. Okay, and the opposite for stop loss order, right, can be used for both a long trade and a short trade. The concept is the same, just the inverse. So let's say, for example, you are in a short trade. Let's say market comes up into this area of resistance and you sell, right? you can put the stop loss order above this high. So if the market breaks out higher, you would exit this trade if the market hits your stop loss at this particular price point. So it's just the inverse, right, of a long entry. So let's do a quick recap, right, of the 4 market orders you've just learned. Number 1, market order gets you into a trade immediately, no matter what. A limit order gets you into a trade only if it comes to a specific price level that you have dictated. A stop order gets you into a trade if the market exceeds a certain price level. For example, let's say buying breakout, only if it, let's say, breaks above, let's say, $100, will you be entering the breakout trade. So that's what a stop order, a buy stop order can do for you. And finally, a stop loss order, right, would get you out of a trade if the market, exceed a certain price levels to protect